Hey guys, I just wanted to start off this lesson with saying that I am not a tax professional, CPA, or legal advisor. The information provided is based on past client experiences and publicly available resources. Business and corporation decisions can have significant legal and tax implications, and the best structure depends on your specific circumstances and where you are. And so always consult a qualified tax professional, CPA, or business attorney before making any decisions regarding your company's formation, structure, and location to ensure you receive the best tax benefits and legal protections when building your app. Without further ado, let's do this. So deciding whether to structure your tech startup as an LLC or an S Corp is one of the most crucial legal and financial decisions you will make as a founder. The right choice depends on how you plan to grow, fund, and distribute profits from your app or digital product. Both structures offer liability protection, but they differ significantly in how they are taxed, how they handle investments, and what flexibility they offer as your business scales. For founders launching an app or digital product without outside investment and with limited upfront funding, an LLC or limited liability company in the US often provides the most simplicity, flexibility, and tax efficiency. As a single member LLC, profits and losses pass through to the owner's personal tax return. And so this means that income earned by the app is taxed at the owner's individual tax rate, avoiding the double taxation that corporations face. Additionally, an LLC allows founders to deduct business expenses such as software development costs, marketing, and operational expenses directly from their taxable income. There is no need for complex payroll structures or shareholder distributions. Founders can withdraw profits as needed through owner draws. Another key advantage is that an LLC allows self-employment tax deductions, which include Medicare and Social Security taxes, though it also means that the founder is responsible for paying the full self-employment tax, which can add up depending on profitability. An LLC keeps financial and tax obligations straightforward while allowing flexibility as the business grows. However, if a founder expects to raise more than $100,000 within the first year in external funding and wants to attract investors willing to take equity in the company, S Corp or S Corporation can be the better choice. Unlike an LLC, S Corp allows founders to create shares and distribute ownership among investors, making it an appealing structure for those seeking angel investment or early venture capital funding. While S Corps are still pass-through entities for taxation, meaning profits flow to shareholders without corporate tax at the entity level, they have strict limitations. They can only have up to 100 shareholders, and those shareholders must be US citizens or residents. Investors looking for traditional stock options, preferred shares, or convertible notes may find an S Corp too restrictive, as S Corps can only issue one class of stock, limiting flexibility in structuring investor agreements. So despite these limitations, an S Corp provides tax savings on self-employment taxes, as founders who actively work in the business can pay themselves a reasonable salary and take additional profits as dividends, which are taxed at a lower rate than ordinary income. This structure allows a founder to reduce their overall tax burden while still benefiting from pass-through taxation. For startups expecting to scale beyond early funding rounds and bring on multiple investors from the beginning, a C Corp rather than an S Corp or LLC is usually the best long-term choice. This is because venture capitalists and institutional investors almost always prefer C Corp structures, as they allow for multiple classes of stock, equity-based compensation for employees, and tax advantages. So, while a C Corp does introduce double taxation, once at the corporate level and again when dividends are distributed to shareholders, it is often the preferred structure for companies that plan to raise millions in funding and eventually seek an IPO or acquisition. For founders in the early stages, where the app is the sole product and the main focus is growing revenue without outside investors, an LLC remains the best option for tax flexibility and ease of management. If securing six-figure funding from investors is a priority and ownership needs to be structured as stock, S Corp provides the best balance of tax efficiency and investor readiness, though it does come with restrictions on shareholder types and classes of stock. If the goal is to scale rapidly, investors are ready to go, and attract institutional funding and prepare for major exits, restructuring to a C Corp later may be necessary. Ultimately, the choice should align with the founder's long-term vision, as converting from one structure to another can be time-consuming and actually a little bit expensive. Now, let's say you want to have a partner that's in a foreign country, meaning someone that's outside the US, in order to help you build your app as a partner. If one of the partners in the company is a foreign owner who is not a US citizen or resident, choosing the right business structure becomes more complex due to the US tax laws and restrictions on ownership. The best structure depends on how ownership will be divided, how profits will be distributed, and whether the company plans to raise investment or issue stock. If the company is expected to stay private for the foreseeable future, and the goal is to build, operate, and grow an app without immediate institutional investment, forming a multi-member LLC is often the best choice. Unlike an S Corp, an LLC does not have ownership restrictions, meaning a foreign owner can hold equity in the company without an issue. With an LLC, ownership percentages can be divided based on operating agreement, meaning it's an agreement that you write up with your other founder or partner, which outlines the equity split, how revenue is shared, voting rights, and management responsibilities, and of course, exit strategies if one partner leaves or sells their share. This has to be defined, though, in the beginning. A major downside is that foreign owners of an LLC are subject to U.S. tax reporting requirements and must file the IRS Form 5472. Additionally, the LLC will need to withhold U.S. taxes on distributions to the foreign owner, which may require extra compliance and, of course, work. If the startup plans to raise venture capital, issue stock, or scale quickly, then forming a C corporation is the best option. A C corp has no restrictions on foreign ownership, meaning the foreign partner can own shares without limitations. This makes it the most investor-friendly structure, since venture capitalists and institutional investors prefer C corps due to the ability to issue multiple classes of stock, including common stock, preferred stock, and convertible notes. And so, ownership in a C corp is divided by equity shares, where foreign and U.S. partners can own a percentage of total issued shares, stock options, and vesting agreements, which are useful for long-term incentive plans, and dividends or salary payouts, which are subject to tax implications for foreign shareholders, meaning they're going to also get taxed back home. One important tax advantage for C Corps is Section 1202, also known as the Qualified Small Business Stock Exemption, which can provide major tax benefits on capital gains if stock is held for 5 years. An S corporation is not a viable structure if there is a foreign owner, because S corps only allow U.S. citizens or U.S. residents as shareholders. So if a foreign partner owns even 1% of the company, the S corp status is revoked and the business is automatically converted to a C corp, which could lead to unintended tax consequences. If an LLC is chosen, ownership is outlined in an operating agreement, which allows flexible profit sharing, even if the ownership isn't split evenly. This means one partner could own 60%, but receive 50% of profits, or vice versa. If a C Corp is chosen, ownership is structured through stock allocation, where each partner receives a percentage of shares based on their investment or contribution. A U.S. partner and a foreign partner could each own 50% of the shares, or they could structure an agreement where the U.S. partner holds majority voting rights, while the foreign owner retains equity without direct control. Foreign owners in either an LLC or C Corp must comply with the U.S. tax laws, including filing a U.S. tax return, Form 1040-NR, if earning U.S. source income, withholding taxes on dividends if the company is a C Corp, and additional reporting requirements such as IRS Form 5472 for LLCs with foreign members. If the goal is long-term growth and investment, a C Corp is the best choice for unrestricted foreign ownership and better fundraising potential, of course. So if the goal is to operate privately and split profits flexibly, an LLC with a well-defined operating agreement is the best option. Consulting a tax professional and startup lawyer is crucial to ensure proper ownership structuring, tax compliance, and of course, legal protections for both partners. Let's get that company created and your journey started.